Hello and welcome to the Trading Zone. I'm Joe Teague. With me is Brian Stutland. Brian, how you doing?
Great, Joe. Excited to get going on our new show format here. It's going to be an awesome show today. I'm Brian Stutland, Portfolio Manager, Equity Armor Investments. Joe and I manage a couple mutual funds, obviously, and also deal with individual clients. The run of the gamut from investment advisory services to even helping out other investment advisors. And so we're happy to bring this new format to everybody.
Yeah, and, as former options market makers, Brian, you were an early adapter to the VIX options. I was an S&P 500 trader, a lone wolf in a crowd of 500. And those lessons that we learned the hard way, we bring them to you every week here at 1 p.m. Eastern time at the Tradier Hub. We bring them to you, and we help you manage the volatility, put them in your portfolio correctly, and kind of just ride the wave a little smoother in these markets. And it really has been a fun ride. It's been a great year for volatility and for the markets. Volatility's on the low right now, Brian, but there's been some ups and downs, to say the least.
Yeah, it has. It really, the big story of the day today that we like to get into is really talking about, we got unemployment rate coming up, right? So we really want to get into a big discussion on where interest rates are relative to unemployment. And one scary thing, and this is not just a freak out scare tactic for people, but with delinquencies on the rise of credit default, along with a slight uptick in unemployment rate, we're going to get into what that means for the market, because it can get kind of scary compared to the last 3 or 4 times we've seen these types of market conditions happen.
Yeah, and you bet. Well, let's bring it right into the volatility zone. Let's take a look at the VIX futures curve last week, Brian. Volatility was super low, under 12 reading there. The futures were predicting a little bit of a tick up in volatility. We certainly got that, but volatility still remains on the lower end of the range.
It does. We did get a take up. It's been a little scary. Obviously, it was weird. Markets on Friday just rallied out of nowhere into the close, maybe a markup into the end of the month or whatnot. We're seeing markets sell off today, volatility getting a little bit of a pop. It's interesting, though, that the VIX front month future is not rising as fast as what the VIX is. So maybe this little sell off is just going to be a little blip, a little backward fill, people a little bit nervous about the unemployment rate. And that the front month VIX future is telling us that this is probably the right level for the VIX, maybe not too much higher from here.
A little bit of call buying, a little speculation. Maybe word was out. Roaring Kitty owned a bunch of calls in GameStop or something. But yeah, that was an interesting close, to say the least. We're seeing interesting times in the market. We're seeing these big moves, maybe a little bit of price disagreement. But it's certainly led to volatility being on the rise. And this is something that we talk about every week here in the Volatility Zone, Brian, something we keep track of, something if you're new to volatility, follow us. We will guide you through these things. But this is the skew. This measures the difference between the 25 delta put in the S&P 500 and the 25 delta call in the S&P 500. And it's a very good indicator of sentiment, volatility sentiment. When people are paying too much for the puts, it's a sign maybe the sell-off is getting long in the tooth. And the vice versa is true when the calls are more expensive relative to puts. Maybe people have some FOMO. They're chasing after some gains, and it's time to get a little more defensive. Last week, we saw this index rising. People were paying up for puts, and this is a sign that the market was softening here.
Yeah, it was softening, but it's interesting that the last few trading days, we actually have seen call buyers come back into the marketplace and people selling puts, right? Where the skew is now dropping. And if we're looking at it as sort of like a fear indicator here, it's kind of saying risk might come back on, meaning people want to get long the market down on these levels, let's call it 5,200 in the S&P 500, and willing to sort of take some risk on by selling some puts down at those levels, collect some premium, and play for a bounce off these levels higher. We've seen this before where this skew has spiked up, where volatility, the VIX has spiked up, and then all of a sudden this skew shifts, people selling puts, buying calls, and then the market starts to rally.
Yeah, and very interestingly, this shift often happens before the VIX happens to shift. So that's another reason why we like to follow it. Yeah, we'll be watching to see if it continues to have this higher trend, or it does break out this previous high and it starts to trend back neutral or even lower. Here's how it looks on a little bit longer time frame, Brian. This will be a 2-year time frame. Volatility is trending down over this time
Yeah.
frame. No question about it. Volatility is coming in. This is part of what's going on with the Federal Reserve, Brian. They are raising interest rates, and ever since the Fed stopped their hiking and they've been flat, they've been plateaued. We've seen volatility start to come down. Of course, this was true in the 2023 rally, just fantastic. Everyone was expecting the Fed to continue raising. They stopped. The market just kind of went haywire. And really, this trend of lower volatility has been coming on ever since the COVID era. So what happened was there was a ton of liquidity thrown into the economy during COVID. And the Fed had to hike rates, of course, to kind of squash that out. But volatility has just been coming in and in and in as the interest rates have plateaued, and the liquidity still kind of remains out there in the market.
Yeah, I think the reason really being is just like, the skew is an indication of how aggressive people are at buying insurance on their portfolio. And when it's not paying off to a sizable degree, like let's say the COVID era, we start to see less and less people need to buy puts. Now, is that because of ETF flows and people selling options and structured notes and everything else that's grown assets? A lot of investment advisors we talk to these days using structured notes, which is a form of selling volatility. So that trade has continued to be on. Let's watch the skew. If the skew gets to that 5 range, we could be kind of nearing a bottom in volatility. And that's where I'd be very, very nervous about the market.
Yeah, well, a couple of things are likely to coincide. Of course, the election's coming on later in the year, but also, we have the economic data softening. And that goes, I want to bring it back to the Fed, Brian, and this will bring us to our main story right now. And the Fed, of course, raises interest rates to cool down the economy. When that happens, they tighten the conditions for banks, and banks, the short-term yield ends up being higher than the long-term yield. This is called an inversion, and we're actually at some historic levels here, Brian. This is getting kind of scary here. The longest that I pulled up and charted, it wasn't technically a 210, but it was the 1.7 was 1929. That was a 700-day inversion. 2007 was a 540-day inversion. 1973, we had a decade of like weak economic activity and a weak stock market. In the 70s, that was a 534 days. We're over 600 days in our inversion here. So we've been very inverted, and it seems like the longer the inversion, the worse the recession is.
I mean, this is really the big story that we wanted to talk about on the show, because when you look at this, it's pretty scary how long this inversion has gone on for. And it makes me very nervous. I don't know how you feel, Joe, but it makes me nervous that when this, circle of life of volatility happens, and now we've seen volatility very low, the VIX being low, and things start to go a little bad, it could get really bad. I mean, are you nervous about that too, Zach or Joe?
Yeah, well, let's see what happens to the charts on these events. Currently, we're in the purple. Things seem great right now. We're cruising along without a care in the world. But I wonder what things felt in 1929 before the crash. It must have seemed really good. People were taking buying stock on leverage. They were taking out loans a lot cheaper. The Federal Reserve was keeping things, brand new Federal Reserve was keeping things going real nicely. Must have felt good then. In 2007, it was kind of like a mixed economy. People thought, oh, maybe we'll slow down a little bit. Nobody had any idea how bad it was going to get. And in the 70s, it was just already weak. We had weak with everything was rough. So the market was already down. So it just seems like anything could kind of tip us over. Now, that said, the rally could keep going for a long time. We have this liquidity. We talked about roaring kitty very briefly, but that's just a sign to me that there's still excess liquidity out there in the market. People have money to burn. That's what the Fed's doing, working on getting through, I guess, to get this inflation in check. But yeah, this is really getting long in the tooth.
Yeah, I mean, here's the bottom line: is I think it's economic conditions, right? They're still pretty good. We're getting GDP growth. Unemployment rate is still sitting here under 4%, and so all of that is adding up to allowing this yield curve inversion to allow the bull market to continue, where people are comfortable with interest rates and where they're at, versus some of those other time periods of 2007. You get this consolidation period in the market when you have a very extended inverted yield curve. Now in 29 and now, conditions remain fairly good. So the bull market continued for a little longer versus '07 or the 1970s, economic conditions were deteriorating. So what I want to look at is there something in here to show some sort of deterioration? And yeah, Joe, this is it, right? It's the consumer delinquency default rate. This uptick starts to get scary when defaults start rising quickly, right, Joe?
Yeah, and if you go back through here in 1990, here's a big increase. Of course, that's a recession. 2007, that's a recession. Here we are right now. We had one in 94 that kind of was pushed out and didn't really happen until 2000. But yeah, this is a leading indicator for me for recession, and really the biggest leading indicator is what we're going to get on Friday is the unemployment rate, and this leads the unemployment rate pretty well, Brian. I want to take a look at that. I got a chart for you right here.
Yeah, I think so. Yeah, really, when you look at it, it's really about unemployment, where delinquency was rising and then it got pushed out. And the reason being is the internet boom that occurred and the big technology wave that occurred created tons of job opportunities, kept unemployment rate low, and you didn't get a uptick in unemployment to go along with delinquency rates. So when you get those two things happening together, that's recession disaster area, right? We are starting to see that now. Before we've talked about, bad unemployment rates has been good news for the market because the market's feeling like the Fed isn't going to raise rates anymore. They might even cut. Valuations on stocks should go higher. So bad news was good news. But at some point, bad news is bad news. And a rising delinquency rate with a rising unemployment rate is very bad news, right, Joe?
Yeah, that's the moral of the story, Brian, is that bad news is going to be bad news because we know when the Fed actually does cut, that means the economy is weakening, and a weak economy is never good for stocks. So we want the economy to stay strong. We want the Fed actually to not cut for these stocks right now because we want the Fed to stay paused and have a strong economy. You mentioned, these things going up in unison. That's just like the death sign for a recession. Really, it's really about this unemployment. That is a recession. When this unemployment is rising, you're going to have a recession. When it rises like in a meaningful way, in 90, every time this is a recession, right? So if this unemployment rate Friday, which oftentimes this credit delinquency is a forebearer of it, it's a signal, hey, you might start to see this. That's going to be interest rates falling. That's going to be stocks falling. So that's what we don't want to see.
Yeah, and then you couple that, and I talked about the circle of life of volatility. Now you're in a circle of life where we've had an inverted yield curve, and when that goes on for a very long time, and then all of a sudden it normalizes again on the interest rates, that has led to very strong spikes in volatility. So I know we might be talking up our book a little bit, Joe, but really in a lot of our trade ideas, we want to own this volatility as a level of protection right now against owning stocks. And we think this is a paradigm shift because, look, if unemployment rate stays controlled and the bull market continues, I want to own stocks. If we get this shift back to where the Fed has to start cutting rates because delinquencies are rising, because unemployment is rising, and the yield curve normalizes again, we're probably going to get a volatility pop. So I want to own volatility. I want to own some sort of hedge. And I think this is the paradigm that allows us to sort of own this. If I'm a moderate conservative investor, I'm trying to find this mix of rigmarole of things to own. A normal advisor might just have you in passive stuff of stocks and bonds. I want to look for other liquid alternatives to be invested in, and owning stocks with volatility with a hedge has proven, and at least in our strategies, Joe, it's proven to be a winner and outperform a moderate conservative, let's say, risk profile target over the last 5 years even.
Yeah, and that's 100% right. And it's why we strongly believe over time the stock market will be higher. There are periods of volatility. We can't time them perfectly. For instance, in '94, that could have been there could have been a warning sign where it'd been wrong to just time to be long volatility right then. But it does pay to trade smartly, to have an effective use of volatility over time. I will say, it might seem like '94 is like today because of the AI versus like the tech, the .com boom coming on. But a big difference in '94 was you didn't have the yield curve inverted like we have now. So just another reason why you have the yield curve inversion. We have the credit delinquency rising. That could mean that the unemployment rate is short to follow. Moving on, Brian, let's do the stock of the week. If you don't, unless you got something else.
No, let's get at it. I mean, you brought up AI, and who's the leader in AI? It's Meta, right? Or at least one of like the 4 or 5 big names out there that we like to talk about. Our mama stocks: Meta, Amazon, Microsoft, and Alphabet, or Google. But let's bring up Meta here. I mean, it's had a huge run, right? I mean, the incredible bull run it's had. We're getting some consolidation right now this quarter. And obviously, like the TikTok ban that's supposed to go in effect in the second half of this year, if there's no deal to sort of disenfranchise and remove any sort of Chinese ownership in TikTok, if that can occur, Meta should be the leader in there. Even Trump, who has said that's going to give Meta too much power if this happens, is sort of on the fence on it. But Meta should be a beneficiary of it. It's just a question of, right now, can the stock, move higher?
Yeah, it certainly can. We know it bottomed out close to 80, topped out at 530 in about 2 years. So from October 2022 low. Let's take a look at the chart, Brian. What an incredible run, right? $87 to 531, just on a tear. It's one of the best runs you can see in a stock short of NVIDIA. It just had this trend channel, broke out well above that. And now I think we're kind of back into this channel, maybe a little bit of range bound. I think there's more consolidation to be had for me. We went ahead and looked at this channel and we said, hey, given where we are now, we had a little increase in volatility. I think it's wise to maybe do a little bit of a long delta, but selling volatility, selling a strangle here in this channel while we think we can consolidate here and wait for the next move.
Yeah, remember, you can follow our moves. We've been pretty spot on, Joe, with all of our market calls on trades. And here's a trade. Joe talked about that. It looks like, Meta's going to be a tough to get above 500. Like you kind of showed there, it was hard to break out of that green channel into the red. It was able to break out a little bit for, let's call it 2 or 3 months, but now it's right back in it again. And notice the resistance at that 500 mark as well. At the same time, we're still in this bull channel headed higher for the stock, right? So I'm going to sell a strangle here. I'm looking to sell the 500 call. Now, these are calls. This is the regular June options. They expire in 18 days, right? So not a lot of time. But if I sell it,
I get to collect $10
about
here.
$10 for it. So I'm going to sell the first call. Yeah. I'm going to sell the 460 put. So I have to be willing to own the stock below 460. I have to be willing to actually almost to get short the stock above 500. But $10, right, Joe? That's 2% of the value of the stock, a little bit more in just 18 days. You annualize that adds up to a 40% annualized rate of return on your money. So if we can sort of kind of stay consolidated, there's no earnings event during this time, so I'm not worried about some sort of catalyst event taking place. If it goes below 460 and my break even 450, I have to own the stock. I'm okay owning the stock down there. Or we own it for clients currently right now. And if it gets above 500, I think I can probably get out of my short before I get squeezed, given the large amount of resistance up at that level.
Yeah, 100% agree. And I think if it does go lower, it'll bounce higher. First of all, if it does go lower, I'd be happy to take the stock, sell another call against it, continue this buy right type of a trade. It has a little bit of a long delta. We're just going to be collecting these premiums. I think it's going to be range bound. If it does go outside there, hey, we'll have to trade around it, but I'm much more comfortable trading around it to the downside. I think we'll be a little more defensive if we get above this trend line of 500. I think we'll look to close pretty aggressively.
Yeah, that's a great point. Close if it moves higher above 500. Trade around it if it goes lower. I love it, Joe.
I think I love this show. That's another great show. A first one for the Trading Zone. We're going to be coming at you every Monday at 1 p.m. Eastern. We're going to be talking about volatility, about options trading, about portfolio management, and bringing you trades just like you just saw.
Yeah, and keep following along. Actually, we have a nice surprise here. Some of these trades you're going to be able to trade along with us. We're going to make it easier for you. We also have investment models that you'll follow along, that you can follow along with us. So stay tuned. Keep subscribing to our channel. Follow what we're saying. We'll help provide better guidance on investment strategies, and be able to follow my trade and Joe's trade along in the future. But please tune in every Monday, 1 p.m. Eastern. Tune into our new show, the format. Hopefully you like it. Comment, like, subscribe. Give us some feedback on what you think of the format right now. And we look forward to seeing you next week.
Have a good one.
All opinions expressed by Tradier Hub contributors are solely the contributors' opinions and do not reflect the opinions of Tradier nor its affiliates and or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Tradier nor its affiliates and or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actual live trades or positions. Such information is not intended to be financial or investment advice. Tradier Inc. is the parent company of Tradier Brokerage Inc. Tradier Brokerage Inc. and Tradier Inc. are separate entities with their own products and services. Securities products and services are offered through Tradier Brokerage Inc. Tradier Brokerage Inc. is an independent subsidiary of Tradier Inc., all rights reserved, member FINRA SIPC.